Hello and welcome. My name is Andy Last. I'm the media manager here at Pure Financial Advisors, and thank you so much for joining us for this digital workshop, this second quarter of 2020 market update webinar. Your presenter today is Brian Perry, CFP, CFA. He's the Executive Vice President and Director of Research here at Pure Financial Advisors, a financial planning firm headquartered in Southern California with over $2 billion in assets under management. We were ranked among the top registered investment advisors in the nation in 2019 by RIA Channel and Smart Asset. Pure Financial is also one of the nation's fastest growing companies on the 2019 Inc. 5000. Brian Perry has been actively involved in the financial markets for more than 20 years as a portfolio manager, strategist, and trader. He's a widely published author, and his newest publication is Retirement Revamp: Financial Planning in Times of Crisis. Brian has presented at hundreds of seminars and conferences around the country. Hello, Brian. And also appears frequently in the media, including regular appearances on the TD Ameritrade Network and on Your Money, Your Wealth, the radio show, podcast, and TV show. And now please welcome your presenter, who you see there, Brian Perry, CFP, CFA. How are you doing, Brian? A little excited this morning?
I am so excited, Andy. How about you?
I'm very well. Glad to be here.
Life is good.
You're right.
We're occasionally allowed out of hibernation with coronavirus. They let us out and then they brought us back in, but not all the way. So that's good, right?
Well, at least you don't have to wear a tie, right?
Yeah, I suppose. I'd rather be able to go to the movies or out to eat, but okay.
Right.
Well, cool. We've got a lot. Yeah, like Andy said, it's good to be here. We've got a lot to cover today, so welcome. Basically, I want to go over three things. I want to start with just an overview of where we're at in financial markets. Then I want to talk a little bit about something that may have slipped your notice, and that's the election. If you hadn't heard, we have a presidential election coming up. I want to talk a little bit about what that might mean for markets and what historically that's meant. And then from there, I want to dive into a few strategies and thoughts around navigating turbulent times because, folks, it's crazy out there. So let's dive right on in. And we're going to start going through some slides here. And I want to start with, basically, we don't need another picture of me, you've got me, but where do markets stand today, right? And let's look first at the nearer term, and then we'll dive into the longer term. So last quarter was a good quarter, right? Things went up a bunch. Since then, market's a little bit volatile. We are up 22% in Q2, so that's April, May, and June for the S&P 500, about 15% for international markets, and then emerging markets up about 18%. Even bonds joined the party going up. So good quarter. And think about it, guys. That's a good reminder of the fact that just because the news is bad doesn't mean stocks have to suffer. I'll talk some more about that a little bit later, but it's one of the most common mistakes I see people make. And really my goal here today is to educate you, but also to give you some ideas of some of the common mistakes. Like Andy said, I've been doing this a long time. I want to help you avoid some of the mistakes I see. I've met with tens of thousands of people across my time, and there's a common set of mistakes people make. And a lot of what we do here and a lot of what I do is trying to help you avoid those mistakes. And one of them is, hey, the news is bad, stocks have to go down. Not so. Stocks are a forward leading indicator. What that means is that just when the news is most bad is usually when stocks are going up. So flashback to last April. I mean, the news isn't good right now, but it was even worse then, right? But stocks started a rebound from their March lows and had quite the quarter. Let's take a look here, though, longer term. What's happened longer term? Well, over the course of a year, stocks in the U.S. up 6%, right? Think about that. We had a pretty good end of the year, but we were worried about China and trade wars. We were worried about there'd be an election in 12 months. We were worried about the economy slowing down. We were worried about geopolitical tensions. Oh, and then, by the way, this little virus came along and shut down the entire globe. And yet, over that time, the U.S. stock market has gone higher. If you'd set out on a sail around the country, around the world, in your boat, set sail a year ago, you land now, you'd look, you'd say, yeah, a normal year, kind of a quote-unquote normal year. Markets are up mid-single digits or something like that. You had a normal year, right? International stocks, not quite so good, down a little bit, but still not terrible considering the backdrop. Longer term, 5 years and 10 years, you can see annualized returns there, double digits for U.S. stocks. International stocks, not quite as good, although positive. Let's talk a little bit about that, because one of the big stories in financial markets over the last several years has been the bifurcation between the U.S. stock market and international stock market. And people have been calling into question, should I globally diversify? And, you know, there's been a couple things going on that have caused U.S. markets to do better than international markets. One of those is simply that, for the most part, the U.S. dollar has been pretty strong over the past handful of years. As a U.S.-based investor, when the dollar is strong, that is a negative for international stocks, right? You use U.S. dollars to buy foreign stocks that are in a different currency. When you want to bring that money back home, you need to go back out and buy those US dollars to bring it back home. When the US dollar is strong, that's a negative for international stocks. Broadly speaking, it has hurt international markets over the last handful of years. The second thing is simply this. What's been leading the way? What's been leading the way is the big technology companies. Technology in particular, big technology more specifically. In fact, year to date, you know what? The S&P 500 up 2% year to date, right? 2%. But did you know that out of the S&P 500, there are 5 stocks, the 5 big tech stocks, Facebook, Apple, Amazon, Netflix, Google, that are together up 35% in aggregate. The other 495 stocks in the S&P 500 down 5% on the year. So you've got the S&P 500, but it's really 5 stocks kicking you know what, and then 495 stocks that are down on the year. You mash that together in aggregate, you get a stock market that's flat to up slightly, right? Why does that matter in relation to international markets? Simply put, international markets in general have fewer technology stocks, less of a weighting to technology stocks than US stock market. So more technology stocks in the US, they've been doing better, hence US markets outperforming international markets. Let's look at some of that backdrop. This is the stock market around the world, the MSCI All Country World Index, one of the broadest market representations, US stocks, international stocks, emerging market stocks over the last quarter, and you can see a gradual upward trend there. But look at the news flow during that time. At least a fourth of the US economy goes idle from lockdown. Eurozone economy sees largest contraction on record. China GDP falls 6.8%, first drop on record. Right? Look at those news headlines, and yet you get a rising market. Again, bad news doesn't necessarily mean bad stock market. Just to continue to hit on this trend, here's the longer term chart. Stocks headed higher into the end of last year, sharp decline. In fact, that was back in February and March, one of the sharpest declines we've ever experienced in financial markets. Guys, I know that's scary. I know that there was an urge to panic. I mean, heck, everybody feels that. We're all human. You see markets plummeting, you're forced into shelter in place, the economy shut down, it's natural human nature. That gets back to why you have diversified portfolios, of course. Maybe you had some more secure assets to tide you over to mute that volatility, or if you need income to live off of until such time as markets could recover. But for those that stayed the course, look at the rebound. Substantially recovered from that sharp decline, despite, again, a long list of bad news. Let's look at specific asset classes. Best performer in the last 3 months, emerging market small company stocks. Right? Over time, if you think about it, what tends to do the best? Well, small companies historically have outperformed large companies. In fact, if you go back as long as the data goes, about 90 years, right? If you looked at US stocks overall, you would have about, invest $100, you would have roughly, let's figure out how to see this. You put $100 to work, you'd have about $600,000, right? That's investing in all the big companies. You take $100, 90 years ago when the data starts, you slap it in the S&P 500, you get 600K. That's capitalism. That's the power of economic growth of companies doing well over time. However, if instead of the big companies, you put the money in the small companies, you'd actually have $2,700,000. 4.5 times as much, right? Smaller companies historically have done better than large companies. It makes sense intuitively. Trees don't grow to the sky. Smaller companies have more room to grow. Additionally, over time, emerging markets have both higher volatility but also higher economic growth. Those markets have done better. And so not terribly surprising that we've seen in the last quarter a recovery as the economy sort of bottomed out, started to pick up just a little. Emerging market small cap stocks doing the best, right? In the US, Russell 2000, those are the small companies. 2,000 small companies doing the best, right? Followed by the S&P 500 and then sliding down to other markets. But again, you can see that everything did well, right? The worst performer, 1 month US Treasury bills. So again, that's basically a proxy for cash. That's why sitting in cash generally doesn't help people meet their financial goals. Now, everybody should have some money set aside for a rainy day, but as part of a long-term investment strategy, it's tough to accomplish your goals earning 0.02 over time. In the US, like I mentioned, if we just focus up here, smaller companies did better than larger companies. Small growth followed by large growth. A premium on growth last quarter, right? The economy was slow. People are looking for companies that are expanding more rapidly, but all US companies did well. Small value and large value didn't do quite as well, But again, over time, these companies have done phenomenally. So if we look at some of the value companies, again, you buy the S&P 500, you put $100 in 90 years ago, your $100 turns into $600,000. That's pretty good. This is all the big companies: value, growth, dynamic, fast growers, slower, stodgy companies with more debt on the balance sheet, right? If instead of buying all the companies, you just bought value companies, instead of your $600,000, you'd actually have $1,300,000, more than twice as much. Over time, value companies have provided higher returns than growth companies. Again, that makes sense. Think about a real estate analogy. You're going out to buy some real estate. You're looking at two apartments. They both produce a set amount of cash flow. One you pay less for, one you pay more for. It's pretty logical that the one you pay less for is a better investment. The same thing in financial markets. The less you pay for an investment, the better it is, all else being equal. Remember I mentioned the smaller companies historically have done better, right? The 2.7 million instead of 600,000. Well, how about you take this value premium, you add the small premium on, and you buy small value stocks? How much would you have had? Well, instead of your 600,000, you'd actually have about $7,800,000. That's right, guys. You buy small value stocks, you'd have 13 times as much money as if you bought the S&P 500 over time. Why am I bringing that up? Well, most of the portfolios I see, most of the portfolios we look at, heavily concentrated in large companies, sometimes to the complete exclusion of small companies. A lot of portfolios also really focused on growth and large growth. Frankly, they've been the winners. That's where those big technology stocks that have done the best in the last few years reside. But over time, the data is really clear that smaller, more value-oriented companies provide higher performance. They also provide more diversification, so that you get an environment where you have a choice of what to sell. You can sell what's done the best lately. All right, sliding back into some of the markets. Like I said, U.S. stocks did well last quarter. International developed stocks also did well, not quite as well as the U.S. These charts up here in the right-hand corner, you see a blue bar, that's the local currency, and a yellow bar, which is the U.S. currency. So in other words, as a U.S. investor, there's how did the foreign stock do? And then when you convert that back to the U.S., how was your actual return? Remember I mentioned that over the last handful of years, the U.S. currency has been strong, the dollar has been strong, and so that's hurt international returns. Well, last quarter, that story shifted. Last quarter, for the most part, the dollar was weaker. Other currencies did better. What it means is that that helped international investors. So somebody invested in small company international stocks. In the local currency, returned about 18%. But if you look at that in terms of U.S. dollars, up almost 22%. So the U.S. dollar last quarter shifted from hurting investors in the U.S. to actually helping investors in the U.S. Right, I already mentioned emerging market stocks were the best performers last quarter, in some cases the small companies. Right. Here we look at different countries. There's a lot of numbers on here, but I want to point out one thing in particular, and that's the United States. And I'm going to draw in here the United States here last quarter up about 22%. Right, 22% there. Good performance. But look at how many countries did better. Australia up 32%, New Zealand up 27%, Germany up 26%. In emerging markets, Argentina up 36%, Thailand up 27%. So a lot of countries did better than the U.S., which again speaks to the fact that you want some diversification around the globe. Oh, and by the way, getting back to that, bad news can equal good results. You know what Argentina did last quarter? They defaulted on their government bonds yet again. So that's the equivalent of the U.S. saying, hey, we're not paying back our treasuries anymore. We're defaulting on our government debt. Argentina did that last quarter, and yet they were the best performing stock market in the country. Again, bad news doesn't necessarily equal bad stock market. Shifting gears to the bond market, and there's a lot of numbers on here, but what I want to point out is the most important one, which is the Treasury yield curve and the fact that interest rates have come down a lot. So if you look up here at this green line, that's the bond market back a year ago, June of 2019. The yellow is June of 2020. You can see that interest rates have moved down sharply. That's a result of the crisis, right? The Federal Reserve lowering interest rates, people rushing into safety, interest rates coming down, plus muted expectations for future growth. People are more pessimistic about future economic growth, think inflation will be lower, which means lower bond returns. That's a fair bit on where we've been, where markets performed and didn't perform in the last 3 months. I want to shift gears and look ahead to November and a little thing we call the presidential election. But before I do, Andy, do we have any questions?
Yes, we do. Hang on just a second. First of all, the Fed met today and kept rates at record lows. This is from Robert. What impact do you see that having on the markets and the economy?
Yeah, not much, simply because it was highly expected, right? I think that there was almost no real view that the Fed would do anything. Basically, when the crisis started, the Fed reacted very aggressively. So they took some of their toolbox from 2008, 2009 in crisis response. They lowered the overnight lending rate to 0. They flooded the market with liquidity by buying securities, buying treasury bonds and stuff to lower interest rates. Made sure that money markets and stuff like that, which are generally a dull part of the financial markets, but are actually like the plumbing of the financial markets and need to be kept operating. They made sure all that was working, right? A lot of that was stuff they learned in 2008, 2009. They even went further. They went ahead and they got the authority to buy corporate bonds and high yield bonds to make sure that companies could continue to fund themselves in those markets. That's been their response to date. It was expected that it would continue, and it would. So in the short term, not too much of a response to that so far, just because it was expected. Longer term, yeah, I mean, what the Fed is telling you is that interest rates are going to be low for a long period of time. Look, I worked earlier in my career as a Wall Street bond trader. So my first day back in the mid-90s on a bond trading desk, first thing they told me was, don't fight the Fed, right? The Fed's the 800-pound gorilla in the financial markets, and most of the time it gets its way. The Federal Reserve is telling you they want interest rates low right now. I think there's a high probability interest rates stay low for the foreseeable future. Actually,
Mark had a question. He wanted to know, when do you think that the Fed will raise rates again? I guess that answers that question.
All right. Who's got a coin? Geez. I mean, if you can tell me 3 things, I'll give you an answer. If you can tell me, first, when we'll have a COVID-19 vaccine. Second of all, when the economy will begin to pick up for real. And third, when unemployment will get down back to like 5% or something like that. I'm going to go out. But absent that, I mean, I don't know. I don't think it'll be this year, and I don't think it'll be next year. Let's put it that way. If I'm going to speculate any further out than that, it's complete guesswork. But absent something very unexpected, I think rates are pegged near 0, probably for at least, certainly in the next 12 months, probably beyond that, 18 months and beyond.
All right, Janine says stocks have been run up quite a bit lately, and the economy is still weak. Should we be worried?
I mean, yes. Obviously, there's a look. For one thing, I think I've hammered home the point that bad news often equals good stock market returns, and so you don't want to get too hung up on that, right? But the reality is that there is a dichotomy between where the economy is versus where stock markets are, right? And so make no mistake, the economy has recovered substantially from the bottoms that we saw, but it's still at drastically lower levels than we were at 6 months ago, right? So stocks have done pretty well. I don't know. I mean, should you be worried? Yeah. I mean, I think it makes sense to be cautious about things, right? Anytime you see a strong stock market rally, you want to look around and see if it passes mustard. Now, were valuations back in March extreme? Yeah. I mean, they were pricing in Armageddon. We didn't get it, right? We're back out living our lives, spending money and stuff, but certainly economic damage was done. I think you need to define more broadly stocks, though, right? Because a lot of times we talk about the stock market, but really what it is it's a market of stocks. And so there are all different kinds of companies. A lot of growth companies, a lot of small growth companies in particular, are extremely expensive compared to their historic averages. But on the other hand, you look at value companies or some small companies, they're actually less expensive than their historical averages. If you look at international markets, most of those are less expensive than their historical averages. So I think it very much depends on what market you're interested in. And I'll talk a little more about this in a bit, but what I think you want to avoid doing is the mistake of just piling into what's done best or what's hottest right now, because I think that's how you wind up buying into overpriced markets and potentially setting yourself up for a potentially significant declines in markets.
We got a couple more questions. Did you want to take those now, or do you want to wait?
Let's go for it, Andy.
Kenneth would like to know, what's up with artificial intelligence?
I don't know. What's up with it, Kenneth?
I don't think he was referring to me.
Is somebody looking to replace me? Somebody who gets to get a computer up here to do this? I mean, obviously, it's an evolving technology, and it seems to be moving further and further into practical applications. I mean, even just like with Apple iTunes, right? It can tell you, or with your Netflix kind of queue and stuff, it can suggest what you should watch. I mean, those are pretty simple examples. I don't know. When I think of artificial intelligence, I think of every science fiction movie I've ever seen, and the computers always wind up either enslaving the humans or destroying them, like in the Terminator. So I'm not really bullish on artificial intelligence. From an investment perspective, there are certainly niche ETFs and stuff that'll focus specifically on that. There are also funds that will focus more broadly on emergent technologies like that, or 3D printing, and they'll, maybe clean energy, and they'll put them all together. And that can certainly hold a piece of a portfolio, but if you hold a broadly diversified portfolio, you're going to own companies that are involved in that space. And the one thing I would caution is a lot of times in evolving technologies, the early leaders aren't necessarily the winners. And so I would reference, for any of you that use social media, you probably don't use MySpace, right? You use Facebook, but MySpace was the early leader. You probably don't use Netscape to browse the internet. You use Google, but we all use the internet, right? So as these spaces evolve, I think you just want to be cautious in piling into the early leaders, knowing that even if the technology is here to stay, which I think artificial intelligence probably is, the actual what the industry looks like when it's a little more mature is still to be determined.
Mark has a follow-up question on that. What is your take on investing in 5G technology?
I don't have a strong opinion on that, and I mean, we could side pocket that. I would say the only thing I would say is, again, if you own a broadly diversified portfolio, you own companies that are making chips for that and hardware for that and stuff like that.
Michael says the government has read up a huge deficit responding to coronavirus. How will that get paid back?
Well, let's hope it does, first of all, right? Because the alternative's not great. Historically, there's 4 ways when you have a large deficit or large national debt, you have 4 ways to pay that back, right? The first is that you can default. Right? Do I think you could go Argentina's route, right? Do I think the U.S. is going to stop paying its bills? No, right? There have been times we've come close for technical reasons, and that could certainly happen, but that's not the same as a true default. We're not going to default on our obligations. Then you can grow your way out of it. Higher economic growth will allow you to pay down debt, similar to if you had run up personal debt on a personal level, and your career was doing well, you got pay raises and stuff to pay off the debt. That would be nice. I'm not sure it's going to happen. I think the 2 most likely scenarios are, 1 is that we inflate our way out of it, and 2 is that we tax our way out of it, right? And with inflation, I mean, I think for the next few years, you're looking at low inflation, right? For weak economy, high unemployment, people are going to be a little bit hesitant to spend money, and frankly, they're restricted right now in how they can spend money in some cases. So I think in the short run, inflation's not a worry. Longer out, I think the Fed and governments around the world will be more willing to tolerate a little bit higher inflation in order to stimulate the economy. B, I think that the way that you pay back some of the debt is you use less valuable dollars. So I think you could see a little bit higher inflation. But protecting against that's pretty straightforward. First of all, when you do your cash flow planning, which hopefully you're all doing, you map out using some sort of reasonable rate of inflation to see what future expenses are going to look like. Then you hold investments that are designed to keep pace with or exceed inflation, right? Whether those are stocks, natural resources, real estate, whatever it is, you can build a portfolio that will keep pace with that. The second one is taxes, right? And we're really tax focused. When you look at taxes, right? I don't know. We've got trillions of dollars in debt. We had demographic issues and Social Security issues and stuff even 6 months ago. Now you add in $3 trillion for the CARES Act back in March. We're talking about passing another $1 trillion plus in some way, shape, or form next month to support the economy and people that are out of work, which is all good, right? You need to triage. When the patient is sick, you cure the patient, then you worry about the longer term scenarios, right? So you don't necessarily focus on the long-term impacts, but they're there, right? And I think that the way that you cure the deficit is with higher taxes, because right now we have record low taxes, right? If you look at tax brackets, they stair step. And so we have a 10%, a 12, a 22, 24, 32, 35, and 37. These are the lowest rates in history, the lowest rates we've ever had. However, these are only temporary. These came about as a result of the Tax Cut and Jobs Act back at the end of 2017. But because there wasn't a supermajority to pass it in Congress, right? Shockingly, it was not a bipartisan bill, right? These are temporary. They're scheduled to sunset after 2025 and go back to 10 stays the same, 12 becomes 15, 22 is 25, 24 goes to 28, 32 increases to 33, 35 stays the same, 37 goes to 39.6. So we've got the lowest rates in history. They're scheduled to go higher. We already know that absent an act of Congress, taxes are going higher. Then the question is, all right, well, what happens if Congress does act? Right? So Congress does nothing, taxes go higher. Well, what happens if Congress acts? And I'll leave it all for you to answer the question for yourselves, but ask yourself, if Congress decides to do something, to pass some sort of law around taxes, do you think it will be to lower taxes further, or do you think it will be to raise taxes? Right? I know what I think, but answer that question for yourself. I think in a lot of scenarios, we're looking at a future with higher taxes, right? So what can you do around that? Well, what you can do, and I'm just going to go through this high level just in the interest of time, and certainly at the end of this, if you want to go into more detail, we offer up free assessments for, because you need to do something with this information. So at the end of this, if you're like, hey, you know what, I want a little bit more information on some of this, I want to sit down with Brian or one of his colleagues to go through what this means for my future taxes and my portfolio, we're happy to do that. We usually charge a couple $100 an hour, but we waive the fee, free assessment, right? But I'm going to go through it high level for now, is that there are 3 different pools of money that you can pull from in retirement. There's a tax-free pool, a taxable pool, and a tax-deferred pool. Okay? And they have very different rules and regulations. The tax-free pool are generally Roth accounts. The dollars that go in there, you've already paid taxes on after-tax contributions. But when the money comes out, it comes out at 0. The taxable pool, again, you're putting after-tax dollars in. Since you've already paid those taxes, you establish basis, so you never taxed on that part again, but any growth on top of that, you pay taxes on. And if it's done properly, you can get special rates called long-term capital gains rates, which are anywhere from 0 to 20%, and for a lot of people, it's 15%. Right? Then the tax-deferred pool is things like IRAs, 401ks, and other sorts of retirement accounts. Right? This is where the government gave you a tax break when you put the money in. You made $100,000 in a year, you put $10,000 in a 401k, so from a tax perspective, it looks like you only made $90,000. The IRS is so nice, they lent you money, right? But the dollars go in there, they grow tax deferred, but the IRS wants their pound of flesh. They want their money back. So down the road, you're going to have to take the money out and you're going to pay taxes. So if you have money in here, a share of it belongs to the Internal Revenue Service. They're your investment partner along for the ride. At some point in the future, they're going to start to force the money out via required minimum distributions starting at age 72. So even if you don't need the money, the government is going to force it out to get their tax dollars back. Why is that important? Well, keep in mind that if most of your money is in this pool, you do have a tax problem, because for the reasons we talked about, A, taxes are scheduled to go higher. B, if Congress acts, I don't know, it's more likely than not, it seems like taxes would be raised. Well, if tax rates are higher in the future, when you take these dollars out, you're going to be paying more taxes. So for a lot of people, what makes sense is trying to get some tax diversification, because that becomes your hedge against potentially higher taxes down the road. And I do think higher taxes are the solution most likely to come about in order to pay for our coronavirus response and our large national deficit and national debt, right? So then it's about, how do you get money into here? How do you get money into here? And there's a variety of ways. It's a little bit beyond the scope of this class. Again, do more research on that, because I think that this is going to be the key for a lot of people to navigating the decades to come. And if you want to do an assessment with us, we'll run you through some ideas for your specifics on this. Let's dive on in a little bit. Speaking of higher taxes and what might change in the future, let's take a look at the election. All right, let's take a look here. November, right? And coming into the year, if I had asked 100 people, hey, what's going to be the main story for the year ahead? I think that probably a majority of them would have said, hey, the election. It's extremely bipolar, or polarizing, right? All right. Well, what are we looking at? One thing is, and I'm going to be honest here, guys, my goal is to convince you that the election doesn't matter. I'm going to be transparent. I'm going to show you a bunch of slides. That's the goal. And I'm not arguing that it doesn't matter from the standpoint of your political views or the direction of the country or this or that, because I've got an opinion, you've got an opinion, Andy's got an opinion. We all have opinions. But strictly speaking, from an investment perspective, historically, elections, more of a non-event, right? So first of all, look at what happens to your $10,000 investment in the last 80 years, or 60 years, excuse me, right? If you had only invested, you're a Republican, and darn it, I'm dead red, I'm only investing when a Republican's in office, well, your 10 grand turned into 86. If on the other hand, you bleed blue and you're like, you know what, I'm not investing when those darn Republicans are in office, I'm only going to invest when a Democrat's there, your 10 grand grew to 376. So you did a little better. But if you invested under both, if you said, you know what, I don't care, I'm going to vote one way, but I'm going to put my money to work and keep it to work, you've got $3.25 million, right? That's the power of staying invested under a variety of political parties, right? And it makes sense because stocks go up under most presidents. There's a ton of jumbled lines under this, but here's the important takeaway. This is every president going back to Warren G. Harding. Okay, and as you can see, under almost every president, stocks have gone higher. In fact, the only presidents who have seen a stock market decline during their term are Herbert Hoover, Richard Nixon, and George W. Bush, right? So ironically, and this isn't a political statement, but I think in general, Republicans are perceived as being more business friendly. But it turns out that the only presidents that have seen the stock market decline during their tenures are actually Republicans, right? And I don't know that it's necessarily because of the president themselves. It has a lot to do with the level of markets when they came to office, what the economy was like when they came into office and the like. And so, right, the bottom line is that under most presidents, the stock market does okay, right? And that makes sense because over time, stocks go higher. Another way of looking at it, you can see since Calvin Coolidge, blip down with Hoover, but markets have gone up under red and blue, right? So again, staying invested, staying the course. And this isn't to argue that you shouldn't have a view on what's going to happen. The story is the same with sectors. A lot of times you'll hear, well, this sector is going to do good. Technology is going to do good under this president, or healthcare is going to suffer if this president wins, or something like that. The reality is that there's no clear pattern. So this is the election since 1992. And the different sectors of U.S. stock market stack ranked from the best performer that election year to the worst. If you were here live, I'd ask you what the pattern is, and then I'd pause, and you would all look at it really hard, and then eventually we'd point out that there is no pattern, right? The idea is that different sectors do well in different election years. There's no clear pattern. It's impossible to say this sector is going to do best or worst if this person wins. So trying to time the market for presidential elections doesn't work. Trying to time sectors for presidential elections doesn't work. Think back to the Trump election. There was a consensus that Trump was not going to win. Right? It was widely speculated that Hillary Clinton would be elected. But there was also a pretty big consensus that if Trump did win, the stock market was going to suffer. And yet, not only did Trump win, but stocks soared after he got elected, right? Which again points to the collective wisdom and the fallacy thereof. Couple things to keep in mind with as we come up to the election, right? I don't know who's going to win, but I do know that in general, the economy drives the election. Incumbents historically get reelected unless the economy is bad. Well, here's a bit of a problem for President Trump, is simply that look at the 10 states that had the tightest races back in the last election, and then look at the unemployment rate in those states. Minnesota is the only one south of double digits, right? Every other one of those states has 10, 12, 15, 20, 28% unemployment in Nevada. Those are the swing states in the last election, probably going to be the swing states in the next election. Trump's got a bit of a problem there, right? So I think if you're trying to figure out who's going to win, you look at how the economy does in the next several months. If the economy in the next 3 months picks up, unemployment begins to come down in these states and in the country, I think Trump does a victory lap, says, I navigated coronavirus, the economy is recovering, stick with the horse you know. If the economy stays weak, if unemployment stays high, I think he potentially has a problem there. Finally, here's something just to be aware of, to listen up for. Both Republicans and Democrats have unfavorable views of China. Okay, why does that matter? Well, the dominant story before last year and before coronavirus was trade war with China, the U.S. and China kind of butting heads, U.S. the superpower, China the emerging power, right? That story subsided some during the height of the crisis, but it's coming back to the forefront. I think you're likely to see continued rhetoric and headlines around China bashing coming out of the U.S. ahead of the election because it plays to voters, right? It plays to voters. But what I think the most likely outcome is that you'll see a lot of rhetoric and then maybe a search for a deal after the election. So you probably want to buckle up if you're looking at the news, and you're going to hear a lot of rhetoric potentially around trade war with China and holding China accountable and stuff. I don't know, as I think with like a lot of things having to do with elections, the campaign talk will be over here, and then the reality will be over here. So you'll see a pretty wide swing. We're going to talk about navigating volatile markets. Let me pause again. Andy, any other questions?
We don't have any questions at this point, but if you do have one, type it into the chat function, and Brian will get to as many of those as he can. So it's all you, Brian.
Cool. All right, rocking on with navigating volatile markets. Guys, I talked a little bit about this earlier, the FANG stocks, right? The biggest stocks, technology companies, the fact that they're up 35%, the rest of the stocks in the S&P 500 down a couple percent, right? So look at in the last 5 years, the red line is the S&P 500 without the big 6 technology companies. The yellow line is the international stock market, the MSCI All Country World Index without the US. right? I talked about the dispersion between US and international stocks. The reality is that they've done very similarly. It's just that those big 6 technology stocks happen to be in the United States. That's driven the market higher, right? Now, those are great companies. It makes sense to own them. They make a ton of money. But do you want your entire future hanging on a handful of companies, right? Particularly when those companies, as we speak today, are in front of Congress testifying for whether or not they have too much power? Things change, right? And if you don't believe me that things change, I want you to think about the most valuable company in history. This is a company that at the height of its power was worth as much as JP Morgan, Bank of America, McDonald's, Walmart, Netflix, Google, Apple, Amazon, Microsoft, Berkshire Hathaway, and a dozen other corporate titans put together. One company worth as much as all of those if you adjust for inflation. That company was the Dutch East India Company, which you probably haven't heard about since high school history class. It doesn't exist anymore, right? But the point is that when this one company had a combined market value, as high as these combined companies over here, do you think the future was pretty bright? Prospects were good, right? Things changed. The company went out of business. And now this isn't a comment on any company today. It's not a comment on Apple or Facebook. These are great companies. It's just to point out that what's happened in the past isn't a guarantee that things will continue down that path in the future, right? You want to step back and say, all right, what are valuations like? What does it make sense to own? Am I properly diversified? That's probably the biggest takeaway I can give you out of this presentation. I talked a little bit about the international stocks versus the US. Here in green, these are periods when US stocks are doing better. In red is periods when international stocks are doing better. You can see these big cycles, right? International did better, then the US, then international, then the US, then international, US, international, right? This comes and goes, right? US has had a good run. Does that mean that you want to go into what's done best lately? You could, but I'm telling you right now, I've been doing this a long time. Plus, I have a history background as well, so I studied a lot of market history, and I can tell you that historically, the best way to become a millionaire is to start with a couple $1 million and then pile into what's done best lately, because that'll leave you with $1 million, right? It's historically been a terrible strategy. All right, I talked earlier about bad results equaling, or bad news equaling good results, right? Look at here, this breaks down unemployment, GDP, so economic growth, and then S&P 500 earnings into different cohorts. And you can see that when on, and then it shows the S&P 500's return over the last, 5, 6, 7 decades. You can see that when unemployment is the highest, stocks have done the best. When unemployment is the lowest, stocks have done the worst. You can see that when the economy was growing the fastest, stocks do the worst. When it's growing the slowest, they do the best. When earnings are the best for companies, stocks do the worst. When earnings are the lowest, stocks go up the most, right? That sounds crazy. It sounds like a fantasy land, right? But it's the truth. The worse the news is, the better markets have performed historically. It doesn't have to make sense. It just is what it is, right? Because the reality is stocks don't care so much about good or bad. The market doesn't care that the news is bad, the news is good. It only cares about, is the news better or worse than expected? And when things are really bad, there's a lot of room for positive surprises. The flip side is when things are good, when something's been doing well, there's a lot of room for negative surprises. And you want to be really cautious and very aware of that. All right, let's talk a little bit about planning opportunities, right? I talked some about this, right? So where are you from a tax perspective? Because what you want to do at the end of the day is take your investments and marry them with your taxes. So I want to talk a little bit about taking investments and marrying them with your taxes. Before I do that, Andy, I know that I mentioned earlier, everybody out there, the biggest mistake, I've been doing this since 1996, and the biggest mistake I've made over time is seeing people not take action with their finances. I met with somebody this week. I'm so glad I met you. I wish I met you 20 years ago. We hear that all the time. Do something. You've taken 45 minutes out of your day to sit here and listen to this webinar. But if you just take this information and file it away for future reference, it's not going to do you any good. Do something with it. Do more research on the things that we're talking about. Talk to your financial providers about what I'm talking about, or reach out to us. Like I said, we usually charge a couple $100 an hour, but we waive that fee for people that attend an online webinar like this. We offer a free financial assessment. We'll take a deep dive into your cash flows. We'll go through your tax return, see if there's any potential savings now or in the future. We'll take a snapshot of your investment, show you what kind of risk you're taking, what kind of returns you might expect. We'll see how you're positioned for future tax efficiency of income. And most important of all, and this is probably the number one thing people want to know, is if you're retired, can you stay retired? And if you're not retired, when can you stop working, right? So we can take a look, give you some high-level thoughts on that. Like I said, usually we charge a couple $100 an hour. We waive that fee. If you want to, go ahead online, go to the free offer there, click on it. You can either automatically sign up through the Calendly. You can pick a day and time if you know when you want to come in. Come talk to myself or one of my colleagues. If not, just fill out the form. One of my colleagues will reach out to you to set an appointment again to meet with us. No fee, no obligation, but we'll give you some really good high-level thoughts. And you know, the important part too is we're fiduciaries. We're fee-only financial planners. It means we're legally obligated to act in your best interest. We don't sell any products, any commissions. We're not going to pitch you some life insurance product or something like that. We're just going to take a high-level look at your finances, give you our best thoughts and our best judgment. If you want to do that, great, sign up. There's probably going to be a ton of value. It's probably going to be the best hour of your life, 45 minutes of your life that you ever took, not something you're going to regret. If you don't do that, fine, but go ahead, do something with the information, talk it over with somebody else, because the biggest, again, mistake that I see is people regretting they didn't do something sooner. All right, I promised to talk about how to marry taxes and investments, and you've all probably heard in the past of asset allocation, and that's the mix. People have a pie chart. They own some stocks, they own some bonds, maybe they own some international stocks, maybe they own some real estate, whatever. Everybody's mix is different, and they build this portfolio and it's going to get some sort of return, and then they buy it here and they buy it here and they buy it here. The reality is what you want to do is this. As you move money into this pool, you have a pool of money that's going to grow forever and come out tax-free. Right? So as much growth as you can get is going to be tax-free to you. It's also tax-free to your heirs if you pass away, right? So you want maximum growth in there, right? So you take whatever slice you think is going to get the highest returns, you put it in there. Then down here in this tax-deferred pool, you have a pool of money that's going to get taxed at the highest possible rate. And if you pass away, your heirs are going to be taxed at their ordinary income rate, right? And recently, at the end of last year, we got rid of, as part of the Secure Act, the stretch IRA provision, which now means your heirs have to take money out of here over 10 years. So you don't care so much about growth there. So if you're going to have a mix of safe and aggressive assets anyway, you own the more conservative ones in here. Then you put whatever's left over in here. And the idea is that each of these portfolios might be invested differently, but you're looking at them together. And so you're focused on asset allocation across your accounts. You're marrying it with the kind of account. And what you wind up is you don't change the return from your portfolio, but you change how much you get to keep. You're not taking on any more risk. That's the magic. No more risk, but more money goes in your pocket. It's the closest thing to a free lunch you're ever going to find when it comes to investing. With that, I'm going to pause. We'll take any final questions. And again, do something with this information. Come talk to us. We'll do the free assessment. We'll give you thoughts on where your assets lie, if there's strategies to get money into the tax-free pool or the taxable pool. We'll give you thoughts on how your assets are located from a tax perspective. But do something with this information, or you're going to, again, I've met too many people that wind up regretting it later in life. Andy.
All right. So Nancy would like to know, will mortgage rates go any lower?
Maybe. I mean, the challenge is that they're pretty darn low, right? I mean, so if you think about it, they're never going to go negative. So you're not going to pay you to own a home, right? And then it's like, are they going to go to zero? Probably not. So the bank's going to want to earn something. What happens with mortgages is that there's a spread between essentially treasury bonds and the mortgage securities. And that spread is pretty low. The Federal Reserve is going out and buying mortgage-backed securities to keep those rates low. And then it just comes down to how much risk banks are willing to take. So could they go lower? Sure. I mean, do I see a scenario in which they go to 1.5%? I mean, I don't know. I have trouble seeing that, but they're south of 3 in a lot of cases. Can you get it down to 2? Maybe. But that being said, I don't know. If you're borrowing money for 30 years and you're locking in an interest rate of 3%, my guess is that you're not going to go far wrong with doing that. And I would certainly not hesitate to lock. You can always refinance, but I would not hesitate to take out a 30-year mortgage at rates today.
As a reminder, while you've got Brian here, ask your questions of him. Just type them into the chat function. We've got one more at the moment. It is from Ken. Is it safe to assume that tax increases will not take place prior to 2025?
No, absolutely not. And here's why, Ken, is the way that the law is currently written, taxes are scheduled to go higher after 2025, but Congress can always act to change. If we didn't have an election coming up in a couple months, I'd say, yeah, maybe, right? I mean, I don't think Trump is going to raise taxes, but how about a Democrat wins the White House, Democrats win both houses of the Senate, Biden's already floated his tax proposal, which includes raising taxes. So I think that there is certainly a possibility of taxes going higher, particularly as we continue to accumulate debt. I think it's a crapshoot, but taxes could certainly go higher. And this is just my opinion, but I think the odds of taxes over time going higher are very, very high. Here's a stat for you, and I'm cuffing this a little bit, but if you look at all the taxpayers in America, the median tax rate, so the average rate people paid last year was 12%. If you flash back to 1980, the average tax rate was 45%. Right? So the average taxpayer in America paid roughly 1/4% of the tax rate they paid 40 years ago. Right? At a time when we have record high deficits, I don't know. I got to see taxes going higher. And it could be sooner rather than later. Who knows?
Got a couple more questions now.
Yeah.
Mel says, I'm 82. Is it okay to keep leaning some portfolio towards growth funds?
It's a really good question. It just depends on what you're trying to accomplish. So if it's money that you need next year, then no, you want to keep that obviously safe. But for the most part, it's not so much about your age, it's about when you need the money. The reason people in the financial industry talk about age is because a lot of times the older you are, the closer you are to retirement and when you're going to draw down the portfolio. But the reality is it's about when you need the money. So let's say that you're 60 and you need dollars at 65 when you retire. You also need dollars at 85 when you're in retirement. So those dollars have a much longer time horizon. So in this gentleman's question, yeah, I mean, if you have dollars that you're planning not to spend in the next several years, they could certainly still be in growth funds. And maybe you have enough assets that you're not going to outlive them and you're investing something that you want to give to the kids or the grandkids. Certainly that could be in growth funds because they have a very long-term time horizon. So it really depends on your specific situation. But I don't think just because you approach retirement and get earlier or get a little older means that you have to abandon stocks and move all your money into bonds. I think that's generally not the right approach.
Okay, Raman would like to know, what do you think of hedge funds?
That's a pretty broad question, right? Because hedge funds are just a vehicle, right? That's like asking, what do you think of mutual funds? Mutual funds are great, right? I mean, it just depends on what the mutual fund holds. There are good hedge funds and bad hedge funds, and there are a wide variety of hedge fund strategies, some of which have worked, some of which haven't. Some managers have done well, some haven't. The only thing I would caution is that a lot of times they have lockups or gates where they can restrict when you can take your money, so they're not always completely liquid. It depends a little bit on your net worth, because sometimes if they have a high minimum, you may not be able to diversify. And they often have high fees, so you just want to make sure that the manager is going to be able to outperform those fees. Unfortunately, a lot of times what happens is there's a lot of hedge funds that have done really well over time, but the average hedge fund investor in that fund has lost money. And the way that happens is that the hedge fund does phenomenal. It's going like this, right? It's a small fund. It grows, 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 because it's doing well. People pile money in, and then returns tail off. Most of the investors didn't, even though the long-term track record is still good, most of the investors didn't participate in the run-up. So if you can get in a good hedge fund at a time when you think it can continue to do good, that's fine. It's part of your strategy. You just want to do a fair amount of due diligence for sure.
William says, is there new risk in investment-grade bond funds after government stimulus propping up potentially insolvent companies?
No, I mean, that's a great question, but William, but I would actually say there's less risk, right? And the reason that there's less risk is because the government is propping up the bond market, right? So again, the devil's always in the details, right? It depends on what investment-grade corporate bond you buy, right? If you buy a good one, great, and if you buy a bad one, less good. But the Fed's out there supporting that market, so that puts a floor under it, in my opinion, if you look broadly. And then it's just what name do you buy? And certainly if it's a company that maybe shouldn't be able to exist or shouldn't be around, but they're just being carried by the government, at some point the usually comes to roost. But yeah, I feel relatively confident about the corporate bond market as long as the Fed is supporting it. But certainly you want to be selective there because there are a lot of companies that are not going to come out of the current environment unscathed.
We've got another question. Do you think oil will ever return back to triple digits, or will it slowly decline as renewable resources become more prominent?
Jeez, that's a tough. I'm getting some tough ones today, Andy. You're putting me on the spot here.
These folks are smart.
Jeez. You know, I don't know. I go back and forth on this, to be honest, because I think that there's the whole argument about diminishing resources on Earth and growing population and the kind of everything that led to that cyclical or secular rise in commodity prices we saw in the decade of the 2000s. And what do we get up to, like 140 bucks in oil? I think that whole story is intact, and it's been delayed a little bit in the last 10 years because of the financial crisis and now COVID. But the world is still expanding. Countries are growing their populations. More people are getting cars and stuff. So I think there's a continued demand for that kind of stuff. what gives me pause in saying we'll see triple digits again is twofold. One is the fact that you've seen a lot of emerging markets that, if you think of like with phones, a lot of countries skipped landlines completely. They never laid wire and they just went straight to cell phones, right? Because they kind of industrialized later. I can see that happening to a degree with cars and other electrical products where they kind of skip gas completely and go straight to battery, like Tesla type battery and alternative energy. That's one thing that gives me pause. The other is simply that we've gotten way more efficient at finding oil. And so when you look at it, there's tons of production, even just in the US, that wasn't available 20, 30 years ago, that has come online in the Bakken Shale and stuff like that, that I think puts a little bit of a ceiling on prices, where there's a lot of projects that have temporarily been shelved because of lower oil prices that are going to come back online if oil prices rise. And so I think that you've got a little bit of a lid there where prices start to go up and it's like whack-a-mole because then supply comes online. So if I had to speculate, I'd say no to triple digits, but I don't think oil's going away either. I think the truth is somewhere in the middle.
We've got one more question at the moment. David has a kind of general question. Do you prefer ETFs or mutual funds?
Neither or both. David, really good question. I think it's depending on the job you're trying to do. We like both. I think that there's a role for both, and it really depends on what you're trying to accomplish in the portfolio and also the space, right? I think that there are certain kinds of investments that lend themselves better to a mutual fund, and so something that we use a lot of institutional mutual funds, which have higher minimums where, you know, maybe one client doesn't meet it, but as a firm we can aggregate and meet it. And what that allows some funds to do is invest in strategies that are maybe, if they had a lot of cash flows in and out and a lot of hot money, they wouldn't be able to do. So there a fund makes sense. If you're trying to be able to trade in and out of the day with like tax loss harvesting, which we also do, their ETFs are a little bit more efficient. So they're both really good. And then it really, again, the devil is in the details on which one you buy.
And that's all we've got.
Cool. Well, thank everybody. Again, yeah, if you want to come in and do the free assessment, we look forward to meeting with you. I think that, you know, the opportunity is there to potentially, especially considering how much things have changed this year, right? I mean, think about where we were just 3 or 4 months ago. We were meeting people in person, maybe 5 months ago now, meeting people in person, doing these in our classroom here in the office. And, you know, the world was not a coronavirus world. Markets hadn't gone through one of the sharpest declines in recovery on record. We didn't have double-digit unemployment. I think almost everybody's finances in some way have changed during the course of the year, and getting a second set of eyes, getting somebody to take a snapshot of that, seeing what the taxes look like, which a lot of people tend to ignore, is something that there's a lot of value to. So if you want to come in, do the assessment, great, contact us. We'll reach out to you to schedule that. If not, again, do something with this information, and best of luck going forward. We appreciate everybody coming out, and hopefully you learned something today. Take care.